of days and hours every year. And, to get a standalone bill signed into law, there are multiple procedural votes, and it takes up quite a bit of time to get it through the actual Senate floor. I think if you recall last year with the Genius Act, Genius took about 4 weeks, but that included some failed procedural votes along the way. And so with clarity, we need to condense that. We need to be able to move it faster and quicker. But I think the good news is the number of issues remaining are very few and very small. And so hopefully we can get those worked out, get the process kicked off, and wrap this up next week before they leave. The thing to know about this bill is that you need 60 votes in order for it to pass. And the reason you need 60 is because in the Senate, any single senator can stand up and filibuster legislation unless you get this 60 vote threshold in order to end debate and limit it to a certain number of hours. And so that 60 number is very important. Well, first of all, I do think the inclusion of ethics language that was signed off on by Trump was a very big deal. I think the fact that he agreed to something like this is highly unusual. Most asset classes don't have their own specific ethics provisions that go along with them. And in fact, most presidents don't impose any kind of restrictions on themselves. So I think the fact that he agreed to this is incredibly significant and really can start off a negotiation. Essentially, he agreed to no issuing or sponsoring of digital assets, with divesting those assets or putting them in a blind trust if they already have them, and that the Department of Justice can enforce them with civil penalties. So this is much stronger than anything that has ever existed before. And so I do think it is actually a pretty good starting point. I am also, though, not surprised that the Democrats didn't be like, oh, we will take exactly the first offer we get from Donald Trump. The Democrats are also incredibly good negotiators. And so they're having conversations right now with a small group of them, along with Senator Tillis from North Carolina, who is a Republican who's not running for re-election and has, not been afraid to push back against Donald Trump.
A lot of people don't really understand how open source works. And I'm not saying I am the total expert here, but essentially, it allows you to download it onto a machine and then you can change it on there. And so there's technically no centralized entity. But what happened is that you're leveraging, a lot of these open source models, they make money based on APIs, assuming that people aren't going to fully host it locally. And how you look at how people use open source versus closed source, it's not one or the other. They're using things for different things. So there's also a problem there. But I don't know if a ban is going to solve that, especially because this is another weird fact. So Hugging Face used the open source model to figure out what was happening. And it's unclear from the background about whether they realized it was OpenAI or OpenAI came and told them it was them. It's unclear. But in the future, if someone's using an open source model, you are not going to be able to tell who it comes from. So then you're sort of screwed.
Commissioner Peirce released a statement last week about vault and on-chain lending that I think is actually one of the more important crypto statements we've seen from her in a while. So I've seen a lot of takes on what this statement was trying to do, but I personally read it as a warning shot, but also collaborative, right? She's basically saying, look, come in and talk to us because these things do raise regulatory questions and we want to better understand whether and how they may come within the SEC's regulatory perimeter. Salman, how did you read it?
Yeah, I agree with you. And I think one of the key call outs is for those of us in the industry to just come in and help educate the crypto task force and the SEC staff in terms of the Vault ecosystem. And I really break that down into the what I'll call the Vault supply chain. So both Vita and Plume are developers of Vault protocols, or on our side it's the Nest protocol.
But I know we're going to talk a little bit about the open weight versus closed weight debate here, and we seem to be in this max that protocol thesis now in AI, where everything's attributing to the foundation, and eventually the apps will take charge. But open versus closed weight is really where crypto comes in. I've been thinking a lot about this lately, and if you look what AI is doing, it's really disrupted Web 2. And I'd say even Google, we're showing this with Google right now as they're having to double down and change their CapEx and everything else. We had SaaSpocalypse, right? And the one thing that the light bulb hasn't gone out on yet, and this really plays into the open versus closed debate. And you saw the all-in guys, bantering about crypto versus AI, AI versus crypto. I've got news for everybody. AI and crypto go hand in hand. If there's one technology that will be powered by AI, it's crypto. And I think the ethos of open weights is starting to play in. We published a piece, Sandy Call, my colleague, published a piece this week around the rise of the agentic economy and how it's really happening. Whereas SaaS was disrupted by AI, crypto is going to be empowered by AI once we get through some of these security issues, which are getting solved.
What's good for the public are open weights, right? The world needs more low-cost, abundant intelligence, low-cost, abundant energy, low-cost, abundant robots and care and labor. So that's what open weights delivers. If you are Anthropic or you're OpenAI or you've got a proprietary model, then you live in a closed weight world and you want to extract rents from that proprietary IP. That's their natural incentive, and they're entitled to do so under capitalism. Now, capitalism has distillation as a part of our core feature, right? The Wright brothers created the airplane in 1905. A decade later, new companies, high growth companies like Boeing and Lockheed Martin were formed, distilled the Wright brothers IP, and created these new planes and form factors. Wright brothers did not benefit from that. That's just called competition and capitalism. So let the market play out. Let's see how it evolves. I hope that we do see successful open models. I also hope that the closed model framework can win too, because they can then raise capital and fund more R&D. So let the market do what it does best.
Zooming out, there's definitely a very strong institutional demand for blockchain tokenization as infrastructure. I think, the Bitcoin price is a little bit subdued at the moment, but that surely will come back, in my opinion. Essentially, we have built the BVIV index, which our canonical sort of, flagship index is a 30-day tenor. We have the only Bitcoin volatility index term structure in the market. And so you can look at the expectation for the market over the coming 1 day, 7 day, 14 day, 60, 90, 180. Different things happening in the market can be visible in this term structure. We show it on our website, charts.volmexfinance/BVIV, or search for BVIV on the Volmex website. Essentially, we've noticed a slightly elevated volatility index for the 14-day in the term structure. Polymarket really distills that down into a very simple user experience. And I think this has been a very successful collaboration so far, where our indices are tradable in the very simple format of prediction market. And typically, if you're a retail investor in the US and you want to trade the VIX, you might need to trade the VIX options. And so that's much more complicated product. Simplifies things to have a volatility index in a prediction market wrapper. And so I think that this unlocks just a lot of new product offerings for us, specifically making BVIV tradable on different tenors. We have 1 month and 1 year that are currently available on Polymarket, but I think that there could be surface area to have shorter duration contracts that are expiring in a matter of days. I think that as we create new indices, this is a really great medium for trading them and commercializing them. And so I think that we think a lot about prediction markets, and it's a really great product that it's I liken it to the innovation of perpetuals, right? I mean, perpetuals really changed the landscape for crypto derivatives, and I believe that prediction markets is another generation of that.
Heads up, everyone, we've now fully transitioned Bits and Bips to its new dedicated channels. So if you're not yet subscribed to the new Bits and Bips channels on X, YouTube, Spotify, Apple Podcasts, or wherever you get your podcasts, go there and subscribe now. For the next few weeks, we'll play segments of the full interviews on Unchained as a reminder, but for now, you'll only hear those short segments of Bits and Bips on Unchained, no more full episodes. You can get links to all of the dedicated channels with the full episodes at unchainedcrypto.com/bits and bips, spelled BIPS. Thanks again. Before we dive back in, a quick word about something we make ourselves. If you like the way we cover crypto on this show, clear-eyed, no shilling, just what actually matters, you'll like the Unchained Daily. It's our free newsletter that lands in your inbox every weekday, with the most important stories in crypto written by journalists, not marketers. No jargon, no hype, no number go up cheerleading. Just the news you need to stay ahead in the time it takes to drink your coffee. Subscribe for free at unchainedcrypto.com/newsletters. If you hold crypto on your phone, your biggest vulnerability.
Hi, everyone. Welcome to another episode of Bits and Bips, the interview. My name is Steve Ehrlich. I'm the head of research at SharpLink and also your host. We've got a terrific show for you today, but as always, before we dive in, just a little bit of housekeeping. Nothing that you hear or see on this program is financial or investment advice. For full disclosures, please see unchainedcrypto.com/bits and bips. And now let's briefly pause to hear from one of our sponsors.
This episode is brought to you by Cape, America's privacy-first mobile carrier. Same premium service you'd expect from any other carrier, but designed so your number, your location, and your data actually stay yours. Get 33% off 6 months at cape.co/unchained.
All right, welcome back. So got a terrific program for you today, a terrific guest. I have Chris Galipeau. He is the head market strategist at the Franklin Templeton Institute. So welcome, Chris.
Thank you, Steve. Thanks for having me.
Yeah. Got a lot to talk about today. I'm really excited to have you because you're, I guess, a self-described permeable. There's a lot of FUD out there, fear, uncertainty, and doubt. I know you're not a crypto native, so maybe you're not up to date on all the lingo. But there's a lot of concern about all the uncertainty in the world, the Iran conflict, oil spiking, tariffs, worries about just like an unending spending spree of CapEx from the Mag 7 and sort of the big AI hyperscalers. And you've been pretty consistent throughout the year that fears of sort of the market topping out are overblown. And we're going to explore all of that today. But before we do, just really briefly, can you just, for anyone in my audience that doesn't know who you are, explain what you do at the Franklin Templeton Institute?
Yeah, sure. Happy to. First of all, I am not a permeable, just so we're clear on that. We can go into it later, but I do my best to be objective and unbiased. And having spent 25 years as an analyst and a PM, you're never perma anything, right? You're working with the data. So Franklin Templeton Institute is a part of Franklin Templeton, the asset manager. We run about $2 trillion. The Institute is really the thought leadership part of the organization. So in my role as head strategist, I spend most of my time in the US working with our US clients. So it falls under my purview to build and outline our investment views and opinions, usually for a 12-month window. I will comment, on a weekly basis within that 12-month time frame, and just try and keep our clients updated on what we see, what we think, what's happening. Like, this is a great week to be on because there's a lot going on. But you're right. I mean, for calendar 26, we've been bullish, we've been right. We could even take it back to longer than that. And I think the themes or the pillars of that argument are still in place. But this will be a great conversation because we can cover everything you just mentioned.
Yeah. So let's start with the news from yesterday. It was Kevin Warsh's second meeting chairing the Fed. And it seemed, my impression from kind of watching at least the beginning of his press conference after the rate announcement, which was basically to hold the whole thing steady for at least another 2 months, he seemed to be taking a bit of a valedictory victory lap, seeing how like rates were going up on their own, the market was deciding, and the Fed didn't have to use forward guidance, didn't have to do all these things. And then he started talking, and the market did not seem to like that. So I'd love to just first get your impressions on sort of how his remarks went and the quick drop and the rise, especially in the 30-year after that happened.
Well, I think I agree. I generally agree with what you just said, where he spent a lot of time talking about, and this is the second time he's spoken, obviously, and he spent a lot of time talking about almost retooling the Fed's kit and pulling in different experts and building these task forces, 5 of them, to try and evaluate how they assimilate data and make decisions based on the data. So I think that's going to take some time. But he did talk a lot about yesterday the bond work, quote unquote, doing the work for them. And so I've written about this extensively probably within the past 4 weeks, every week, where I was having a hard time understanding the movement in 2-year yields, 2-year note yields, which has a phenomenal long-term track record of predicting Fed policy, right? The bond market tells the Fed what to do, not the other way around. And so yesterday, to your point, he said, 2-year yields have already moved up. They're 50, 60 basis points above the effective FF rate. That's the bond market telling the Fed, you need to raise rates, right? And that track record is almost perfect. At the same time, he also referred to the other variable that I watched and that I've written a lot about, which is break-even rates, which have gone through the floor, collapsed from March. And so that piece of market information is telling us we don't have to worry about inflation, but the 2-year note yield is telling us we do, and the Fed should move and not sit tight, right? So I found it confusing because on one hand, he's saying, hey, we rely on market-based indicators and the market is the best source of information, which I agree with 100%. But yet the market is telling us this one thing vis-a-vis 2-year yields. And, I don't necessarily believe that right now. So the reaction in the bond market was for 2-year yields to come in, thinking that, okay, he's probably not going to move here. Well, we didn't think he was going to move yesterday anyway. And he's probably not going to move in September either. And the 30-year guy is saying, I'm from Missouri, right? You're talking a big game, prove it, we don't believe it. And so you had the curve twist steeper on that. Interestingly, 10-year yields really didn't do that much, right? But they're banging around 470, 475 here. But I think that was the reaction in the bond market. And then you saw the reaction as soon as he was done talking, it was a straight down move, vortex, in S&P futures. And I think that's the stock market saying, okay, we don't know what to think here, right? Because he's promoting this lack of forward guidance. And at the same time, he's saying, we believe the market-based proxies are the best, and we want to retool while we're going to build the plane while we're flying it. The one thing the stock market doesn't like, Steve, uncertainty, and they got it yesterday.
Yeah, I like your analogy of sort of like retooling the plane as you're flying it, because Kevin Warsh steps in, and I know this is the first time you and I have spoken, but he steps in at a really challenging spot because it's sort of a Rorschach's test, reading the economy, reading the labor market, all this macro uncertainty as to what is the right thing to do vis-a-vis rates.
Right.
He has to find a way to establish consensus at the FOMC, which is harder now because I don't remember exactly how many of the most recent votes have had dissents, but it's really broken with decades of precedent. And then you have a president who wants us to quote unquote have the lowest rates in the world.
Right.
And Kevin Warsh, he has to navigate all of that. I wonder, I don't know if you've ever had a chance to speak with him, if you ever met him, but what do you think how do you think he's weighing all those different things? Because clearly, if he's not getting guidance from the White House, he understands what the White House wants.
Yeah.
And so raising rates would be theoretically problematic from a political point of view, but at the same point in time, there's so many different ways you can read the economy.
And that's what he said yesterday. He was asked directly by one of the reporters in the room. We've got another inflation data point this morning. How much do you actually believe in this 2% target? Is core PCE your measure? And he basically said, yes, it is. But we're open to evaluating everything and not just going to be reliant on that. Although we are anchored to the 2% number now. So there's a whole host of things in sources of information, market-based and otherwise, that he can look at. I'll give him the benefit of the doubt, right? Because I personally am a big believer in the market, or the markets are the collection of intelligence from around the world and different pieces of information, right? They are always the best reflection of what's known and knowable right now. The dot plot, if you look at that and test it, it has no predictive value, right? It's not really useful. He's right on that. As for Trump, I agree with what you said. Warsh has come out and stated, kind of like Jay Powell did, we're not going to be swayed by that. We need to be independent. Okay, I get it. I hope that's accurate and true. But I think he is willing, seemingly anyway, he's willing to be patient here and see what the data tells us on a go-forward basis, and kind of bring in these other groups of what he called, world-class experts to evaluate and go back to first principles. That's his favorite term, right? Let's go back to first principles and assume that we know nothing and build it up that way.
Mm-hmm.
We'll see how it plays out. But every new Fed chair gets tested, and I think he got tested yesterday. I think there are other things that are going on in the equity market that had really nothing to do with yesterday. We can talk about that in a minute.
Yeah.
So I think it's kind of it does seem like they're building the plane while they're flying it, which doesn't seem to be the approach that you'd want as a market participant, right? Where we want information and we want we want to understand the process. We want to understand what sort of data you're using. What's the frequency? What's the source? What can we expect? And he's kind of pulled that away, and that's not easy for markets to digest.
Yeah, and before we move on to some of the other topics that you just alluded to, I want to just double click on sort of his revised, or I guess, his new approach to communication. The reduction of forward guidance. I know that it really became a big thing during the great financial crisis, like carried on during Powell. And I've said many times on the show that I think part of it is just perhaps maybe Congress abdicating its own responsibility because of just how clogged up it's been from a policy point of view, that the Fed has to become even more ever present in our lives. But you kind of just hinted on it. Markets don't like uncertainty. So, I mean, he wants to rely on data. He doesn't want to sort of be the Wizard of Oz, like managing things behind the curtain, but it didn't seem to hit the right note yesterday.
I agree. I mean, I listened to the whole thing and I walked out thinking, what did he just say? What should I believe? And I think that was the general, you read the notes. I'm not an economist. You read the notes from the street this morning, even last night after the press conference, and that was the general consensus right now. The market might have overreacted a little bit yesterday, shaking it off a little bit now. Look, I'll be honest with you. I'm only interested in what the Fed does if they're starting on a new rate hike cycle or they're about to start a new rate cut cycle. Those are the only real pivot points that I care about. I'm just speaking as an equity guy. I care a lot more about fundamentals, i.e. earnings and earnings season, than I do really anything that War said yesterday. Granted, I stipulate, I thought he was confusing and not yesterday was not helpful. I think he's got a heavy lift now to restore his credibility, right? And we'll see how it plays out.
Okay. All right. Well, we're going to talk about a lot more, but before we do, we have to take one more quick break.
If you hold crypto on your phone, your biggest vulnerability isn't your wallet. It's your carrier. AT&T, Verizon, and T-Mobile have been breached again and again, and SIM swaps are still one of the easiest ways for attackers to drain accounts. That's where Cape comes in, America's privacy-first mobile carrier. Same premium service, but Cape rotates the identifier on your SIM every 24 hours, deletes your call and text metadata after a day, and protects against SIM swaps with a 24-word recovery phrase that only you control. You also get 2 middle-to-end encrypted secondary numbers for banking and signups, so you stop handing your real number to every app that asks. Go to cape.co/unchained and use code UNCHAINED for 33% off your first 6 months.
All right, welcome back. Speaking with Chris Galipeau, head market strategist at the Franklin Templeton Institute. We just spent a lot of time talking about yesterday's FOMC meeting and Kevin Warsh perhaps not meeting the moment, but he'll get another chance in 2 months. But there's much more happening in equities markets and the macro landscape than just what happened yesterday at the Fed. So let's get into it. I want to talk about Iran and just sort of I'm not quite sure how to say it, just the quagmire that we're finding ourselves in, and like how you read the way the market is responding. I mean, big surges in oil over the winter, early spring, although it didn't reach the eye-watering levels that I think some were afraid of. Markets kept going up for the most part because of just excitement about AI. There was a deal that many people did not expect to last, and surprise, surprise, it did not. And now we're seeing strikes renewed again. Oil is starting to peak up, but it hasn't reached those lofty levels from February and March. But there's the fear of a further regional conflagration. I mean, the Red Sea is now part of the conflict. Egypt's being attacked. Like, how are you reading all of this? Like, what kind of questions are you getting from your clients?
So the playbook for any sort of conflict is generally goes as follows. I've mapped out every major geopolitical event globally going back to 1929, all of them. And so I got in the business in 1991. I've seen a lot of them, right? Mm-hmm. But I've seen World War II, the Great Depression, all that sort of thing. Yeah. If you look at the data, here's what the data shows you. From the start of the conflict, you pick the conflict, right? Wars, acts of terrorism, bubbles, black swans like COVID. You pick the start date, and then you measure out equity returns 3 months from the start date, 6 months, 12 months. Here's what you'll see in the data. That 12 months out from every major conflict that we've seen since 1929, the S&P is up 11% on average with a 76% hit rate of positive returns. So that data set alone tells you that investors should not react to some sort of political or geopolitical event. Now, that's really easy to say, and in practice, that is not easy to do, right? So we've just seen a couple here since Trump has been elected, the tariff debacle, and now this situation in the Middle East, right? And the questions that I get from our clients are, they run the gamut, as you might imagine, Steve, but people see this and they're like, oh my God, the world's going to end, right? And this is going to be terrible for the economy. It's going to cause a recession. No, it doesn't. It never does. There are 3 instances in that whole data set going back 75 years, 3 time periods where the returns out 1 year were negative. Those 3 periods are as follows. The Arab oil embargo, 73, 74. The tech bubble, exacerbated by 9/11. And then the GFC. So 2 bubbles, one situation where we have, shortage of gasoline and gas lines in the US. None of those are likely. We're not in a bubble. We're not going to run out of gas. And the other thing, in all 3 of those scenarios, the Fed was raising rates. Now, we might run into the raising rates thing later this year, but over time, the stock market focuses primarily on one variable, and that is corporate profitability, i.e. corporate earnings. That is what matters. So if you measure the relationship going back to 1950 to right now, and you measure the correlation between S&P price movement and S&P 500 reported earnings, that correlation is 0.98. You want me to shorten the timeframes? I can. You want me to pick different indices? I have. The correlations are all above 0.85. That is the variable that matters. And so for this year, you go through the crisis in the Middle East, you get the spike in oil. The playbook in any geopolitical conflict is sell the spike in oil, which is exactly what I wrote and told our clients. That worked, right? But the reason the stock market has hung in there so well is we're probably not that impacted. I mean, Europe and Japan and other countries are more impacted. Those markets held in there pretty well too. And the question
You
is,
can add
why?
like the Russia-Ukraine conflict to that as well, too. Us being somewhat insulated.
Right. I mean, if you go to that one, then you've got the price of oil elevated north of $120 for way longer than we've had in this Iran thing. I'm not saying it couldn't happen and that wouldn't be a risk, because it would be. But equity markets are focusing on earnings power. And so if you look at Q1 earnings, right? Q1 earnings in the US were plus 25% year on year. That was mildly better than street consensus. And when I say mildly, I'm being sarcastic. It was 100% better. So that's the variable that really matters. And interestingly enough, if you go point to point, January 1 to right now, this distance, right? The S&P is cheaper right now than it was on January 1, 6,800, 74, 7,500. The tape is cheaper now on a multiple basis. That's how strong the earnings growth has been. Q2, it's a little bit mixed here. Last night was a little bit mixed with Facebook and Microsoft, kind of 2 tails of the same coin, but your earnings running ahead of expectations again for Q2. So I think that's the thing that folks need to focus on. It's easy to get caught up in the headlines and what you see and what you read and the constant negative drumbeat and spin. Okay, I listen to it. Most of it has zero validity, easy for me to say, right? That's why I rely on the data and I use the data to inform me, not the other way around.
Yeah, I know that. I mean, every geopolitical conflict is kind of like a snowflake. I actually used to be an intelligence analyst for the U.S. military, so I studied all those conflicts in very different ways. And
I have questions for you then.
but I understand. I mean, even like looking past like the GFC, I mean, take a longer time horizon. Obviously, the market has more than recovered all of those losses, and the Arab embargo. I mean, that was just a one of one where we had to like bring down the Nixon era inflation, and it coincided with the oil spike. But I'm wondering if you can maybe just go a little bit deeper into that data. I mean, when I hear numbers like averages and so on and so forth, I mean, as well as I do that like it can smooth over outliers. It can smooth over like some other types of data. Is there anything else when you did that research that could kind of maybe give a little more granularity into or is it really just as simple as the market always comes back, and perhaps today might be because of tech productivity, or there's a Fed put that makes sure that like the governments make sure the markets just don't crash because it's bad politically? Maybe just add a little more to that, please.
Yeah. A couple things, right? So I gave you the mean. I know the median number too. It's right in line with it. I don't data mine, right? I think that's just ethically incorrect. But let's say this. In those three periods, 73, 74, tech bubble, GFC. So kind of one kind of black swan sort of, and then two bubbles. If you took those out, which I didn't, and the data I just said, if I took those out, then the average goes plus 15, the median goes plus 18, and the hit rate goes plus 85, right? So, but I didn't exclude it, I included it. I think the data is just what it is, and I think the explanation for it is what we just talked about. The explanation for it is if you've got earnings moving north by northeast, S&P prices or stock prices are also going to move north by northeast. The stock market follows earnings over time. The stock market leads earnings over time. It does. But look at semiconductors, for example, right? Not to get too far off the tangent. Pick one. Let's pick the semiconductor index. Pick Micron. Doesn't matter. Micron and the SOX index broke out a year ago. Okay, a year ago. That was the start of the information edge saying, hey, this AI spend is probably going to cause a lot of demand for compute and memory. So smart money knew that. That's when the buying started. And then you get into this frenzy here in the last month and a half, which was pure speculation, right? Amplified by levered ETFs, single day options, margin, right? Crowding all of that, chasing performance. I told our clients a month ago, this reminds me of March of 2000. So I was a growth PM. Thought I had all the answers in March of 2000. Found out that I didn't. I confused my intelligence with a bull market. I knew that semi thing would end. It just came unwound completely, right? And so now the froth and the risk is probably taken out there. But that's a really good example of stocks leading fundamentals. And if you plotted earnings growth for you pick the company over that time frame from 12 months to 3 months ago, you would see that those stock prices were right. But I think that's the notion, that's the thought, and that's the reality, that the stock market always comes back to earnings growth. And let's face it, corporate management teams are paid to continually produce better outcomes. If they do, generally, stocks follow. If they don't, stocks go down, right? And the index can go down. The only thing that really puts earnings under pressure, Steve, is the Fed raising rates and breaking it and putting us into a recession. That's tech bubble, that's GFC, right? A little different with COVID, but same concept. But it's usually the Fed that breaks it that causes earnings degradation and puts us into a recession. And you know what? The stock market moves before that. It knows the earnings degradation is coming. And the stock market rallies 6 months prior before the end of the actual recession, as dated by the NBER, right? These are all examples of why I don't rely too much on economists or economic data or what the Fed says. The stock market tells you if you're paying attention and know where to look.
Okay. So let's talk a little bit more about AI. I mean, as you mentioned, and anyone watching this, I'm sure is well aware. I mean, earnings have generally been very, very good. But there are concerns. And I think sort of the two sides of the coin you mentioned between Meta and Microsoft, I mean, going in opposite directions. I think that's a really good sort of microcosm of sort of the different approaches someone can read what's happening. So maybe just expand on that a little bit, please.
Yeah. So I listened to both the calls last night. And what put Meta in the penalty box was, hey, we raised our CapEx spend. They didn't raise it by a lot. They raised the lower end by $5 billion, which seems like monopoly money to us, right? But they raised it. They talked a lot. They gave us a lot of qualitative explanation, but I didn't see any proof in terms of revenue growth, or maybe no clarification on the timeliness of discernible ROI. I didn't hear that. Now, maybe other people did. I didn't hear it. That's why the stock's down 10%. So they raised their CapEx guidance, and Q3 revenue guide was a little below the midpoint. I know these are nitpicky things, but this is what the street reacts to.
And from my opinion, I don't mean to interrupt you, but just given how poorly their initial LLMs were received, it seems like from my perspective, the burden is higher for them to prove that they're able to kind of catch up and overtake, especially with some of the Chinese competitors.
Yeah. And then right after that call, I got right on Microsoft's call, right? I can, of course, see all the earnings, revenue versus consensus, margins, so on and so forth. And the number one metric we're looking for with Microsoft is Azure growth, right? Cloud growth. And that number was super strong. That was the first thing. I thought, okay, that's really what we wanted to hear about. Microsoft's management, the quantitative information that they gave us, and the tone in which they delivered it was, having listened to earnings calls for 35 years, you pick up on these things over time. They were confident. You could tell. They maintained their CapEx guidance. So they didn't raise it. And so that's the worry around sucking out all the free cash flow generation from these unbelievable companies here in the last 6-8 months or a year, where if you and I were talking 2 years ago and you said, hey, do you think Microsoft, Google, Amazon, and Meta are going to blow through all their free cash flow? My answer would be no way. They just did, and they're in the market borrowing more, right? So investors have called timeout on that. And I'll lead you to another concept that we've been pounding on here for the last 18 months, but those were the differences to me anyway in the calls last night, and why one stock is down and one stock is up.
Yeah, it's really interesting because when we hear about these big tech companies, I mean, going back to like the FANG and I forget some of the other acronyms that were there. I mean, they were enormously profitable, had very, very, very low CapEx and like unlimited free cash flow. Yeah. A big inversion now because of how, the revenues are great, but Google went to public markets for the first time in decades. I mean, these companies are raising tens of billions of dollars in the debt market. I know Oracle was recently downgraded to like one ring above junk status. Mm-hmm. And yeah, free cash flow is all of a sudden it's a big deal. Maybe for some of my viewers, some of my listeners that are just trying to get their arms around all this, could you maybe just talk about how, from your perspective, like you think about these different buckets to sort of ascertain the health of a company? Because it's hard sometimes, I think, to distinguish between like Microsoft and Oracle and like. Yeah.
I'll do my best in a nutshell from a high level. So you need to consider a lot of different variables, right? Zuckerberg, for example, last night talked about total addressable market. On and on, right? Okay, we get that, right? That's why the spend, and then there's not nearly enough compute demand and all that sort of. So you factor in comments like that. You look at the company's balance sheet. What I always focused on, especially as a growth manager, owning these names and liking these names, over decades, is how much confidence do I have in the run rate and revenue? Tell me about COGS. I need to know where the margin numbers are likely to go. I don't really care about the tax rate because it doesn't move that much, but I'm trying to get my arms around all of the different things that will impact net income, factor in buybacks, what's the earnings power going to look like? And so there are a lot of levers you can pull on an income statement, right? You can reduce expenses to boost margins. You can have an earnings beat because the tax rate was lower. There's all kinds of manufacturing, right? You buy outstanding shares back and the EPS number goes up. So you can engineer earnings. You cannot engineer the statement of cash flows, right? And so to me, maybe not so much as a growth investor, but certainly if you're a value investor, you're looking at that a lot, right? But in this case, where you have I'd argue the best run companies on the planet blowing through all of their CapEx, lending it to each other or backing deals in a circular fashion is a concern. I'm not saying it's not a concern. That does concern me, because if this whole notion that, the models are evolving, by the minute, by the hour, getting stronger, can update themselves and improve, right? And everything that we know at the moment, and therefore going to demand these data centers and all this compute power. If something goes wrong there, and they're levered, right? I shouldn't talk about their interest expense ratios because I don't know them off the top of my head. But when you take out the cash flow to meet obligations, that is a risk, right? So that's the bear kind of argument. I guess you could make the counter argument by saying, hey, Chris and Steve, if they're running one of these companies, they probably wouldn't be blowing through their cash flow generation and investing all this money in this unless they completely believed it. High conviction. Doesn't mean we're right, but I think that's what the management teams do believe.
Yeah. I'm glad you kind of brought up the circular nature of it. I think the pejorative connotation that I've seen thrown around is sometimes like a degree of incestuousness between all these companies. But at the same point, like they're complementary, and there's a certain level of scale you have to play in that arena. So like where else could they really go? But it does, like if this breaks, like it could be calamitous just because of how closely entwined they are to each other. Like who ends up holding the bag if something goes wrong, and would one bring down everyone? I know that's a question. I don't know if that's a question you get, but that's a question that I often get asked.
Yeah, it's hard to say, but that's you're talking about the domino effect. Once someone falls, it's kind of, boom, 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 and everybody goes down. Look, anything can happen in our business. We know that any stock can go to zero. We know that. I've seen that. I've owned stocks and thankfully sold them and watched them go to zero. So that can happen. Our take on this, honestly, our bottom-up fundamental take on the whole thing, the whole AI spend and where we are in baseball terms. We were talking before we got on there. You're a Phillies fan. I'm a Red Sox fan. So in baseball terms, we're probably in the second inning of this. And, don't take my word for it. Go listen to earnings calls and listen to companies, all different cap sizes, all different industries, all different sectors. I promise you, right? And to the listeners, anyone can listen to an earnings call from a public company. Go to their investor relations website, click on the webcast and listen, right? Read the transcript if you want. On every earnings call already this year, and this has been this quarter, but this has been true for probably the last 12 months. Every company talks about how they're using AI in their business, whether it's to improve efficiency, productivity, ultimately profitability, to make things faster and better for their customers, to improve their service levels. We've heard that for a year. I hear that in every single earnings call. So this is not going away. The use case is tangible. And now you've got large public companies talking about, hey, we're not just thinking about this, we're using it. And oh, by the way, we can demonstrate improvements in efficacy by a whole host of measures. But what we really look for is, has that improved, operating income? And so we're starting to hear that. Now, I think Microsoft did a really good job last night and their call, Meta didn't. We'll see what Amazon and Apple say tonight, right? But we're probably in the second inning of the game. The risk is there that the whole thing is a bunch of BS and it falls apart. We do not believe that. We do not believe that. We think we're in the second inning of a 9-inning game, and this is real. Now, that's okay conceptually. That might not line up to making money in the stocks, which is a completely different, different game.
Yeah, it's funny, and you have to take into account like SG&A and like all the. I mean, I know this is probably a bad example, but I mean, thinking about like DraftKings or FanDuel, I mean, these companies they're not profitable because they spend so much money acquiring customers and keeping them. It's interesting. Although I do wonder, like
companies like Peloton, Callaway Golf, revolutionary companies, doesn't mean the stock's going up.
Yeah, it's kind of interesting. I wonder too if at some point, I know these aren't like GSIB banks, but I wonder if there's like they get so big and they're so consequential to the industry that we need to find some way to sort of what's the term? It's
too big to fail.
What? Yeah, too big to fail, and then have some sort of like resolution plan in case something like that happens.
Like the TARP setup in 0809?
No. It's I'm blanking on the word. It's it'll come back to me after we're done. But basically, almost having like a living will for a company or something like that.
Okay.
So that, but maybe I'm getting too far afield there. Okay, I want to ask you a couple of really good discussion here. I want to ask you a couple of questions. I'd love to get your thoughts on prediction markets. I mean, they've become very commonplace. I know they're closely associated with crypto. Polymarket is built on top of blockchain rails. Kalshi is not. Polymarket accepts a stablecoin. Polymarket accepts a stablecoin. If I misspoke, Kalshi does not. But they've gotten very popular as a way to either make money based on like good market intelligence. Hopefully not insider trading, although that's kind of a fine line when it comes to prediction markets, but also it's being used as a hedging tool or as a way to read the industry, read where certain like macro factors are headed. I don't know if you've had a chance to look into it yet, but I'd love to get your thoughts.
So I have not looked into that personally. Of course, I'm aware of all the prediction markets. Here's what I think's interesting. Let's step back for a second and talk about the concept of markets having predictive value, right? Because I believe that 100%. Warsh seems to believe that. In my career, I've seen that many, many times. And so there's a great book that listeners can go to Amazon and buy. It's called The Wisdom of Crowds. And so the wisdom of crowds has nothing to do with investing. I think actually the last chapter might be on the stock market. But the wisdom of crowds starts out in the first chapter by a bunch of folks trying to guess how much a cow weighs or a steer weighs. And then it leads you from that point forward and goes through industrial changes and revolutions, through medicine and science and discovery. And what the book proves, beyond a reasonable doubt, not that we're in court here, but what the book proves is that the collective wisdom of a group of people from different backgrounds, not associated with each other, the group conclusion, Steve and I and 500 people, guess how many jelly beans are in the jar? And in the crowd, there were 2 jelly bean jar counter experts. And the rest of us are just, I'm an equity guy, Steve's a Bitcoin guy and a journalist. The sum total of all of our wisdom will be more precise than the jelly bean expert counter, the 2 of them that are in the room. So the sum total of the wisdom of all the folks in the room is more powerful and more accurate than the quote unquote 1 or 2 experts in the room on any subject over all time periods. And so if you believe that, and I do, and it's been proven, then I think the prediction markets probably have some sort of predictive value, because what do you actually have there, right? You've got people betting with their own money for an outcome that they believe in. Now, I don't know if they're going to be right or wrong, but they believe it. And the movement of money matters. That is the stock market, the same thing, right? Money moving because you believe you've got some information edge or source of information or differentiated viewpoint that is not well represented in the stock price. And therefore, you're an aggressive buyer. And then the news starts to filter out. Other people get it, and the stock keeps going up. And lo and behold, there's the fundamentals, 6 months, 8 months, 12 months, 2 months, 2 years, 3 years afterwards.
Yeah.
So I haven't studied it a lot, but I think conceptually, I'm into it.
Yeah, conceptually, it makes a lot of sense. And I mean, I agree with everything that you said. I mean, I think the issue, at least with prediction markets, and I actually stopped being a full-time journalist before I had a chance to really dive into it. But numerous studies have come out from Bloomberg, the Wall Street Journal, et cetera, that it's like these things are being driven by a few hedge funds that can manipulate the angles, can manipulate the prices, and it's not necessarily just the wisdom of the crowd and like a representative sample of 500 people. And like that's sort of the difference between like aspirationally and reality. And the goal is to marry the two, because I certainly get that. And yeah, there's a lot of value in something like this. The other piece I still am fascinated about, and I did do a couple stories on this, is sort of how insider trading works in prediction markets, because these are swaps contracts and they don't have the same insider trading laws as some sort of like securities contract. Actually, in a way, it rewards people with inside information because commodity markets are more decentralized, but then there's limits because like nobody agrees that a U.S. soldier betting on Maduro being displaced before the end of December is a good idea. But it's really fascinating, and it just leads to my bigger question for you, which is you're obviously bullish now to the end of the year for all the reasons that we just discussed. But I guess 2 questions. One, what do you think? I mean, maybe a Fed rate hiking cycle, but what do you think would change your mind? And for listeners here, and again, this is almost an entirely macro show. My show usually is a mix of crypto and macro, but for my viewers and listeners that want to maintain a bullish posture but do want to hedge, what do you think in a not official financial advice point of view or way? What would you recommend?
All right. So the variables you need to be aware of here and monitor in terms of equity space is the earnings picture. What does that look like? How is that progressing? You also need to be aware of and be able to measure, are we at peak earnings? Because if that is the case, the stock market will sniff that out. Companies will report good numbers, stock prices will go down, then it'll spread to everything. And you say, well, this doesn't make any sense. and it makes sense because you're at peak earnings, right? And the multiples might look low because you're at peak earnings. The Fed usually is the problem that ends up breaking the profitability cycle. So I think we're okay here through the balance of the year. I think actually the action has not been, everyone wants to talk about AI, Steve. That's what everyone wants to talk about, right? Let me look to my left here for 1 second, just so everyone's aware. The Mag 7 through last night's close is down 5% on the year. The S&P is up 8%. So the Mag 7 is lagging the S&P by 13%. The average stock, the unweighted S&P, is up 14%. So the Mag 7 is almost 20% behind the average stock, right? Why? They're worried about the circular spend, the free cash flow burn rate, and right, when are we going to see some earnings growth on that? So just as a sidebar. The rest of the market's actually great. To hedge yourself, I mean, there are multiple ways you can do it. You can use options, right? Again, as Steve alluded to earlier, this is not advice. Do your homework. Understand what a put option is, what a call option is, how they work, what's the risk, all that sort of stuff. You've got probably an even easier way to do it today, Steve, than we've ever had. You can use inverse ETFs versus the S&P 500, unlevered, twice levered.
Yeah, my audience is very familiar with those in particular. Inverse ETFs focused on strategy. That's one that's a big.
All right, that makes sense. So my advice to everyone listening is this: believe me when I tell you, I've made every mistake you could ever want to make in 30 years of managing money, and I've made them with a lot of zeros. I don't care which way you trade. I don't care which vehicle you use. Do this for yourself. Stop loss, good till canceled. And if you don't know what that means, then you shouldn't be trading. That's like buying a stock or taking a position and not using a stop loss order is like driving a car without brakes. And I'm pretty confident you wouldn't do that. So if you don't understand that, learn it, use them. Protecting your capital, you need your capital to continue to trade. And if it's taken away and a levered ETF can take it away quickly, you're in trouble.
Yeah, no, that's a good point. And then it's funny when I hear conversations like this. I don't know if you ever watched the show Parks and Recreation, if that was something.
Yeah.
But Aziz Ansari's character, Tom Haverford, he was talking once about betting on horses, and he's like, I always win, and you know why? Because I bet on all the horses. And and sometimes, like, maybe that's just the easiest way to do it. I know money managers, like, sometimes they can beat the S&P, sometimes they can't, but maybe the safest thing to do sometimes is to just bet on all the horses and do that. All right, so we need to. We're getting close to wrapping up, but I want to give you a chance to share any final thoughts. If you have any contrarian opinions, if you have any really good ideas, and also where people can learn more about the work that you do.
Yeah, I think we've covered a lot of the ideas. The highest conviction call that we've made to clients in the last 18 months is a very simple notion that the stock market was going to move away from Mag 7 dominance. That's where all the earnings growth was. That's where all the performance was from 2020 to the start of 2025. We told our clients that picture's changing. Earnings power is spreading out. True in the US, right? So don't be over-reliant on one asset class or size or style. Like as Steve just said, spread it out, right? That's been our advice for almost 2 years, right? This semi-unwind has caused the big pullback in EM. Buy it. Japan, same thing. I think there's a lot of people that think we're everyone's waiting for the next shoe to drop. They've been telling me that for 2 years. They've been telling me that for most of my career. Final thought. The world doesn't end that often.
That is a good way to end it. All right. Well, Chris, I'll have to let you go. Really enjoyed having you on. We'll have to have you back. Thank you to everybody for watching and listening. So, but that wraps up everything for Bits and Bips, the interview, but don't go anywhere. Laura is coming up next on Unchained. She's going to host a privacy roundtable with Joe Andrews of Aztec Labs, Jared Hope of Logos, and Mert Humatz of Helios, just as competition heats up between the chains. So don't go anywhere.
year. In crypto, we have scarce digital assets. There will only be 21 million Bitcoin. And in Congress, there will only ever be a certain number of legislative days and hours every year. And, to get a standalone bill